People aren't staying because they want to. They're staying because they can't leave. For decades, the American economy was built on one assumption. If opportunity moves, people move with it. Better jobs, higher pay, new cities. That's how growth worked. But something has changed. Today, the economy still has jobs, wages still rise in some places, opportunities still exist, and yet people aren't moving. Not because they don't want better lives, not because they're lazy, not because they stopped chasing opportunity, but because leaving has become too expensive. Rent resets when you move. Mortgages don't travel with you. Down payments don't stretch across cities. And one wrong move can erase years of financial progress. So people stay, not where opportunity is best, but where the cost of leaving is survivable. This isn't about lifestyle choices. It's about a system that quietly turned mobility into a financial risk. And when people can't move, the economy doesn't crash. It freezes. The mobility myth. For most of modern American history, mobility was the release valve. When one region slowed, people moved. When industries declined, workers followed opportunity elsewhere. That movement wasn't just cultural, it was economic infrastructure. Housing was flexible, jobs were mobile, and the cost of relocating was small enough that moving forward didn't feel like gambling your entire financial future. That assumption still shapes how we talk about the economy today. If wages are higher somewhere else, people should move. If a city offers better jobs, workers will follow. If a region stagnates, labor will flow out. On paper, that logic still works. In reality, it's breaking because mobility no longer depends on willingness. It depends on housing. And housing is no longer neutral. Moving today isn't just about finding a new job. It's about resetting your entire cost structure. Rent doesn't transfer. Mortgage rates don't move with you. Property taxes, insurance, and local fees reset instantly. And in many cities, just entering the housing market requires a down payment that exceeds multiple years of savings. That means moving has shifted from an opportunity decision into a balance sheet decision. For homeowners, the problem is obvious. Millions are locked into mortgages with rates far below today's market. Leaving doesn't just mean buying a new home. It means surrendering a financial advantage that may never exist again. So even when better jobs appear elsewhere, staying put is often the rational choice. Not because the job is better, but because the housing math is worse. Renters aren't free either. In theory, renting should enable mobility. In practice, it now punishes it. Moving cities often means giving up below-market rent. It means competing in tighter, more expensive rental markets. It means higher deposits, higher monthly payments, and higher risk of instability. The moment you move, your housing cost snaps to today's price, not yesterday's. So renters delay. They renew leases they've outgrown. They accept longer commutes. They stay in cities where wages lag, because leaving would mean paying more just to stand still. Mobility used to smooth inequality. Now it amplifies it. This is why labor market data can look strong while opportunity feels inaccessible. Jobs exist, openings remain, wages rise in select regions, but people don't move to meet them. Not because the economy stopped creating opportunity, but because housing turned opportunity into a risk. And when mobility breaks, the effects don't show up immediately. There's no crash, no headline moment. What appears instead is friction. Jobs stay unfilled. Wages rise without productivity. Regional inequality deepens. Growth slows, quietly. The economy keeps running, but it runs less efficiently. The dangerous part is that most policy still assumes mobility works. Economic models assume workers can relocate.
Urban planning assumes people can absorb higher housing costs. Labor shortages are treated as training problems, not access problems. But when housing stops people from moving, labor stops flowing. And when labor stops flowing, opportunity stops equalizing. This isn't about preference, it's about constraint. And once constraint replaces choice, the economy doesn't adapt, it freezes. In the next chapter, we're going to look at how housing turned from a neutral backdrop into a mobility trap, and why even high wages no longer guarantee freedom of movement. Because once housing locks people in place, the geography of opportunity stops mattering. What matters is where you already are. The lock-in economy. Why moving stopped working. For most of modern economic history, mobility was the release valve. If jobs disappeared in one place, people moved. If wages were higher elsewhere, workers followed. Housing adjusted. Labor reallocated. The system bent, but it didn't snap. That mechanism is now breaking. Not because people lost ambition, not because they stopped chasing opportunity, but because housing has quietly turned mobility into a financial risk. The modern housing market doesn't just determine where people live, it determines where they are allowed to go. The lock-in effect is the clearest example. Over the last decade, tens of millions of homeowners secured mortgage rates that no longer exist, rates below 4%, below 3%, in some cases below 2.5%. These rates aren't just cheap financing, they're embedded subsidies locked into a specific address. If you bought a home in 2020 or 2021, your monthly payment is no longer a market price, it's a historical artifact. Moving today means forfeiting that artifact. Even if you buy a similarly priced home, the payment can double. Not because the house is better, not because your lifestyle improved, but because the financing environment changed. This turns what should be a neutral decision, relocation, into a deeply asymmetric one. Staying put preserves value. Moving destroys it. So households adapt. They decline job offers. They commute longer. They accept lower wages relative to skill. They stay mismatched, not by choice, but by constraint. This is not a behavioral story, it's a structural one. And it doesn't stop with homeowners. Renters face a different but equally binding version of immobility. In theory, renters should be more flexible. No mortgage, no selling costs, no rate lock-in. In reality, rents reset instantly and often brutally. Moving doesn't mean starting fresh. It means stepping into a higher rent regime, larger deposits, higher fees, and less security. In many cities, relocating for a better job simply transfers the wage increase directly to housing. A 10% raise disappears into a 20% rent reset. So renters don't move either, not because they're comfortable, but because the math doesn't justify the risk. This is how mobility dies quietly, not through prohibition, not through crisis, but through cost structures that turn movement into a gamble. The result is visible in the data. Interstate migration has been declining for decades. Job-to-job mobility has fallen. People stay in place longer, even as the economy becomes more volatile. This isn't a cultural shift, it's a pricing signal. Housing has stopped behaving like a flexible good. It behaves like a toll.
And once mobility declines, the consequences compound. Labor markets stop clearing efficiently. High-wage regions struggle to attract workers. Lower-wage regions retain talent they can't fully use. Productivity gaps widen, not because skills are scarce, but because access is. This is where the housing crisis stops being about affordability and starts being about economic performance. An economy where people can't move is an economy that can't reallocate. It doesn't collapse, it calcifies.
opportunities concentrate geographically, wealth concentrates spatially, and inequality stops being about income and becomes about address. Housing didn't just get expensive, it became a gatekeeper. And once housing controls who can go where, every other solution starts running into invisible walls. Because before you can fix jobs, before you can fix wages, before you can fix opportunity, you have to deal with the fact that the economy no longer lets people move freely inside it. And that's where the problem deepens, because the places with the most opportunity are also the places that have made moving in the hardest.
Who pays when mobility breaks? When housing locks people in place, the damage doesn't spread evenly. Some households feel friction, others absorb shock, and a small group turns immobility into profit. The first to pay are workers early in their careers. Young professionals are supposed to move toward better jobs, toward higher productivity, toward opportunity. But housing blocks that path. High-growth cities now require upfront costs that exceed wage gains. Relocation bonuses disappear into rent. Raises evaporate before they improve living standards. So many never move at all. They settle early, not because it's optimal, but because it's affordable. This is how housing quietly lowers lifetime earnings without cutting wages. The second group paying the price are renters with unstable income. When housing is flexible, risk is spread. When housing is rigid, risk concentrates. A job loss no longer means downsizing and relocating. It means staying put and stretching debt. Credit cards, buy now, pay later, short-term fixes. Housing doesn't cause the instability, it amplifies it. And once stress enters the balance sheet, it doesn't exit quickly. Meanwhile, firms adapt in ways that look like solutions, but aren't. Companies raise wages in high-cost regions, they add remote roles, they split teams across cities. But these adjustments treat symptoms, not structure. Productivity suffers, coordination weakens, and wage inflation flows directly into rent. Housing captures the benefit. Workers keep the risk. Now look at who doesn't pay. Existing homeowners in supply-constrained markets. Rising prices increase equity. Low fixed-rate mortgages reduce monthly exposure. And immobility works in their favor. When fewer people can move, their assets face less competition. Scarcity isn't a problem to solve, it's a feature to defend. This is why political resistance forms so quickly whenever supply is proposed. Mobility for others means dilution for them. So the housing crisis isn't just about affordability, it's about redistribution through immobility. We transferred flexibility from workers to assets, from labor to land, from the mobile to the already settled. And once that transfer is complete, the economy doesn't adjust through movement anymore. It adjusts through stress. Why policy keeps failing? Housing mobility didn't collapse because policymakers lacked ideas. It collapsed because every real fix creates visible losers fast. On paper, the solutions are well known. Build more housing where jobs are. Allow higher density. Reduce approval delays. Legalize multifamily homes in single-family zones. Every serious housing report reaches the same conclusion. And yet, almost none of it happens at scale. Not because it doesn't work, but because it works too directly. Start with zoning reform. Upzoning threatens one thing voters protect more than wages: existing home values. For homeowners, housing isn't shelter, it's retirement, collateral, status. Any policy that increases supply near them introduces uncertainty, and uncertainty is politically radioactive. Even modest density increases trigger resistance.
traffic, schools, neighborhood character. The language changes, the incentive doesn't. Then there's construction itself. New housing doesn't appear instantly. Costs are up front, benefits arrive slowly, but the political cost is immediate. Noise, disruption, visible change. Politicians operate on election cycles. Housing operates on decades. That mismatch alone kills most reforms. What about subsidies? Governments try to bypass supply constraints by helping buyers and renters pay more. Tax credits, down payment assistance, rent vouchers. These policies feel compassionate. They poll well. They fail quietly. Because in a supply-constrained market, extra demand doesn't create homes.
It creates higher prices. Subsidies flow straight into land values. Landlords capture them. Homeowners benefit. Affordability doesn't improve. The system absorbs the money and stays frozen. So policymakers pivot to safe solutions: remote work, transit investments, incentives to move elsewhere. But these don't restore mobility, they reroute it. Remote work reduces pressure in some cities while intensifying it in others. Transit expands access, but often raises prices near stations. Every workaround shifts demand without unlocking supply. And that leads to the central contradiction. Housing policy is judged by intention, but it succeeds or fails by incentives. If a reform doesn't lower prices, it's not a solution, it's a transfer. If it avoids conflict, it avoids effectiveness, which is why most housing policy today is designed not to solve the crisis, but to manage dissatisfaction. So when people ask, why hasn't housing been fixed yet, the honest answer isn't technical, it's political. Because restoring mobility means reducing scarcity. Reducing scarcity means reducing rents. Reducing rents means lowering asset values, and no system built on asset protection voluntarily chooses that path. That's why housing stays stuck, not because solutions don't exist, but because the real ones break the coalition holding prices up. And in the next chapter, we'll examine what a real solution would actually require and why it remains politically impossible. What actually breaks when housing gets cheaper? Every discussion about affordable housing avoids this question. Not how to lower prices, but what breaks when prices actually fall. Because housing is not just shelter, it's the financial foundation of the modern economy. Start with homeowners. For most households, the home isn't their largest expense, it's their largest asset. Lower prices don't just mean cheaper homes, they mean lower net worth. A 10 to 20% decline in home values erases years of forced savings. It weakens household balance sheets. It reduces borrowing capacity. That matters because consumption in modern economies is built on collateral. When home values rise, people refinance, they spend, they absorb shocks. When values fall, that process reverses. Housing affordability improves while future supply disappears. Now look at local governments. Property taxes fund schools, infrastructure, public services. When prices fall, revenues lag, budgets tighten. Cities dependent on property tax growth face impossible trade-offs: raise rates, cut services, or borrow. Housing becomes more affordable, municipal finances become fragile. Then there's the financial system. Mortgages are not just loans, they're securities. Trillions of dollars of pensions, insurance portfolios, and retirement funds are tied to housing stability. When prices fall broadly, defaults rise selectively. Refinancing dries up. Liquidity tightens. This isn't a 2008-style collapse, but it's systemic pressure. The system doesn't break all at once, it stiffens.
Credit becomes harder to access. Risk tolerance shrinks. Housing gets cheaper. Credit becomes scarcer. And finally, mobility itself. If prices fall unevenly, owners in declining markets become trapped. They can't sell without realizing losses. They can't move without bringing debt with them. So affordability improves somewhere, while mobility declines everywhere else. This is the paradox policymakers never say out loud. Affordable housing is not a free upgrade, it's a redistribution. From asset holders to future buyers, from landlords to renters, from existing homeowners to mobile workers. Every gain has a mirror loss. And because those losses are concentrated, visible, and politically active, the system resists change. That's why housing doesn't correct, it locks. It stays expensive, illiquid, and exclusionary. Not because prices can't fall, but because the economy built itself to rely on them not falling.
What a real resolution would actually require. By this point, one thing should be clear. Housing isn't expensive because we lack ideas. It's expensive because every real fix collides with something the system depends on. So the question isn't why housing is broken, it's what kind of break the system is willing to tolerate. There are only a few paths that actually restore mobility. The first is sustained income growth. Not temporary stimulus, not asset inflation, but wages rising faster than housing for years. That's historically rare and politically slow. It requires productivity gains, labor bargaining power, and structural shifts in how income is distributed. In other words, it's the cleanest solution and the hardest to manufacture. The second path is real price declines. Not stagnation, not inflation catching up, but actual nominal or real drops. This works, but it forces losses. Homeowners lose equity. Developers lose margins. Local governments lose revenue. Financial institutions reprice risk. This isn't catastrophic, but it's uncomfortable. And discomfort is exactly what policy is designed to avoid. So price declines are managed, slowed, or stopped long before they restore mobility. The third path is overbuilding, aggressively, consistently, for a decade or more. Not luxury units, not constrained supply, but volume. This is how affordability was restored in the past, but it requires cheap land, cheap financing, political consensus, and tolerance for lower prices. In a system where housing is an asset first, that combination rarely survives contact with reality. The final path is demand reduction. Fewer buyers, less leverage, lower speculative pressure. That means tighter credit, higher down payments, and less financialization of housing. It stabilizes prices, but it also slows growth. And slowing growth is something modern economies are deeply allergic to. Notice what all real solutions have in common. They don't preserve everything. They trade stability for mobility, assets for access, wealth effects for flexibility. There is no version of affordable housing that leaves the current system untouched. That's why people don't move. Not because they don't want better jobs, not because they lack ambition, but because the economy optimized for price stability, not human mobility. Housing became something to protect, not something to use. And once that happens, movement becomes friction, risk, and loss. This isn't a crash story, it's a lock-in story. A system that still functions but no longer flexes. Where people stay put, jobs go unfilled, and opportunity becomes location-dependent. Until something gives. Income, prices, credit, or growth expectations. Because mobility isn't optional. It's how economies renew themselves. And when people can't move, eventually, the system has to. If this analysis helped you see the housing problem more clearly, subscribing helps this channel reach people who are asking the same questions. And if you disagree or think something here doesn't hold up, the comments are open. I read them. Thanks for watching. I'll see you in the next one.